Welcome to a special mashup edition of the Acid Capitalist podcast and the Buy-Side Meets Sell-Side podcast.
Happy Friday, everyone, and welcome to another episode of Buy-Side Meets Sell-Side. Every month, I invite one of the best buy-side investors in the world to discuss the most pressing themes in global macro seen from my perspective on the sell side. I'm your host, Andreas Steno, and joining me today is the esteemed Hugh, Hendry, founder of the Eclectic and Macro Hedge Funds. It's an honor to host you, Hugh. Welcome to the show.
Heavens, we were just talking about the past. The founder of Eclectic Asset Management, a hedge fund that ended in 2017, and now he's the CIO. I'm making this up. This is all about asset capitalism. Lay your love on me. Lay your disdain on me.
But we'd actually like to pick your brain a bit from your experience at Eclectic and Macro Fund today, as we will discuss the recession risks and how to position for a recession ahead of it without burning too much carry. But I'd like to start with a brief discussion on your assessment of the world right now, Hugh. I mean, I've seen you've had some heated discussions on Twitter lately in relation to the macro outlook. Do you still see the recession ahead of us?
Well, I mean, I've got to blame you. I've got a list. I've got about 10 lists. Yeah, and again, the genius of Twitter is, there are some smart people in the world, and there's this utility where we all feel compelled to drop some views. I think it's the portal of frustration. We read financial press. And it just doesn't seem to square up with what we're seeing, and so Twitter offers this opportunity to shout back at the Financial Times or Wall Street Journal. But I very much enjoy why would I look at a financial newspaper before I went on Twitter? And I got like 10 or so people I follow, and overnight, for me waking up in St. Barts, I can tap into that intel. And you're one of them. Well done. I do enjoy especially the charts that you present. And I'm very much a kind of graphical person, but I mean, there's no smart person that I know that doesn't see the damn recession. We have a recession in Europe. There's something ominous going on in China. The policymakers, the Bank of England has finally rejected its model. It's like, oops, our model doesn't seem to work. The good news is we're not going to follow it now. And I thought for a moment, I was like, wow, that's cool. And I was like, hold on a second. What is the model saying now? And the model's like, cut rates. I'm really sorry about cut rates. Like, the good news is we're now ignoring the model. I'm like, oh my God. And so they're not following model, or they're worried about their models, and so they're now looking at incoming data. Okay, but they're choosing to look at the most lagged incoming data. I mean, core CPI. I mean, I'm sure you must pull your hair out like I do. The R squared, the correlation on producer prices. Where producer prices go is where CPI goes. And producer prices globally. I mean, the US print this week was 0.1%. And the Fed's are going to raise, it's going to hike again. I think this will be the last one. So yeah, as normal, you have policy errors by the authorities. But really, back to the thrust of this conversation and what we do about it, I think we've got to be very cognizant that we live in a world where very few people understand money. And actually we have to appreciate the chaotic nature of the world that we speculate within, and especially that the world of finance is a world of absurdity. The Federal Reserve in 2007 pivoted. They'd raised rates all the way to 5.25%, and they started cutting in September of '07, and that was with the S&P at an all-time high. You know,
Mm.
that Wells Fargo, what, the second or third largest bank today in America, made an all-time high, weeks before the demise of Lehman Brothers. Like strange damn things happen, And so, in constructing a risk portfolio, I think actually one of the things we've got to be very cognizant of is, if you will, the deviate. We know where we're driving to. We're driving into a recession.
Mm.
The skillful element of the deployment of risk capital would be, those absurd twists and turns, and hoping that we don't get lost on that journey, that we actually have to land on the strip.
Mm. Hugh, I'm the kind of guy who typically suffers from the fear of missing out, and to be honest, I'm currently heavily invested in the whole AI theme, the rebounding consumer discretionary stocks, and all the stuff that's been performing like crazy over the past couple of months. It doesn't feel like the price action right now rhymes with the recession risk. So, what do you make of this discrepancy between what we see in markets and the recession risk ahead of us?
So I certainly would not try and persuade you not to have that risk exposure.
Mm.
Um, the um, the portfolio construction that I advocate is pretty much the hedge fund structure. I mean, it's the Bridgewater structure, it's the permanent portfolio structure. It's quadratically. You have equities, you have risk-free government securities, you have real assets, and then you've got cash. And you could be Ray Dalio, and you could have a volatility allocation model. You say, I want a 10% price vol, and you'd have look back on each of your asset classes. You'd be looking at 3-month and 18-month realized vol, looking for changes and allocating in or out. You could do that, or you could come in with your prejudice. For me today, as odd as this year has been, I mean, I'm in St. Bart's. I'm living a charmed life. If we think of $1 million notional, private portfolio, I would have like 200 grand in Nasdaq, or those 7 stocks which are motoring away. But it's 200 grand. It's not $1 million. And we'll come back to it. But I'm constrained just now because where I have the firm macro commitment, the narrative, it's in the US Treasuries. I want to be long duration, but there's no trend validation. And so, am I cheating? But my accommodation to that is I'm using a derivative. I'm using a very simple derivative call option with a lot of time. It doesn't expire until the end of next year. In the real asset space, I got like 200 grand in Bitcoin. If it's $1 million portfolio, it would be via Grayscale. So I'm trying to capitalize on the discount to NEV. I think there's a surety. I think that the Bitcoin is unencumbered. I think it's available, and I think there's a catalyst which they'll succeed eventually in getting an ETF, and that would be the resolution to the discount. And then I've got a lot of cash. I've got at least 500K in cash, dollar cash. I'm earning 5, maybe I'm earning 7, maybe I'm owning some municipal bond, ETF, money market fund, or maybe I bought the Nasdaq, I bought the futures. I've only spent 70,000 less than on buying my call options in treasuries. I could buy the Bitcoin futures, so I could really be sitting with the best part of $1 million, earning 5%. But I've got exposure to the stock market. I've got exposure to a real asset via Bitcoin, and I've got latency. I've got the capacity. If the thing reveals itself in a manner that I find willing, I get a fat pitch. Heavens, I've got so much cash to lay it down. So I'm like, that's the charm. And then you say price action. I guess the thing that is a signal has been the outperformance in the S&P of the S&P versus the equal weighted. The fact that there's such a prominent move in those 7 stocks, and so if you look at a chart of S&P to weighted, it has flares which coincide with all the previous drama moments of the last 15 years. And so you could say that institutional investors that have an ongoing daily commitment to be fully invested are actually, with one eye on what may happen, their equity allocation, whilst it may take them into the highest valued companies, the perception is they're buying the best companies, and they're not actually willing to take cyclical risk, and that's what's giving you this pronounced flare in that S&P derivative.
I want to pick up on the discussion on your call options on US Treasuries. You say you have a rather long risk horizon on these call options. Why did you choose, say, 18, 24 months of runtime on these options? Is it because it's tricky to time the recession? What are your considerations there?
Yeah, I mean, back to my initial point, you've got to deal with absurdity. And if we, in the summer of 2007, I had very, very high conviction that that the teaser rate and the reset would just bring Armageddon. But I couldn't tell you the day or the month. I couldn't even tell you the year. And I ended up, I had the classic 210. Is that a bear steepener where the short rate comes down and the spread blows? But owing to the fog of prognostication, I chose some complexity, and so I had a swaption. I had a desk at Morgan Stanley write me a bespoke contract, and it was the 2-year forward, 2s10. And so the advantage there was I was convinced that within 2 years my strip was long enough, to land profitably. There was no theta decay, so I could just hold it every day. There wasn't a day that passed that was punishing, and so I thought. Now, what was wrong, and the red flag? There was one word there was at least one word in my statement which should cause concern, which is I chose complexity. And what happened was, so I put that position on in May. In September, the Fed's cutting rates. Hallelujah. And by January of 2008, the Fed was cutting rates like 3 times in a week. Hallelujah. But we live in a strange paradigm, and the market, and indeed those beloved ladies and gentlemen that govern the monetary policy of Europe. I mean, the ECB, God love them, but they raised rates in the summer of 2008, and we had oil at $140. And so my friends out in 2-year forward land, every time the Fed cut interest rates, they were adding it back on. So I got no steepening, I got no P&L, and it was torture until like 1 second to midnight when it all came good. So so I'm repeating the kind of the long landing strip. I'm saying I feel like the recession's already onshore in the US. I've got a lot of small, medium-sized business owners that I speak to, and they're finding it really, really difficult. The economic data from the Raoul's various kind of chart packs and stuff. I mean, everything is descending in a manner that seasoned pros have seen before. But I'm just not confident that in saying it's this year, but I'm confident saying it's within 18 months. Boom, yeah. I've got some theta on the 25. It's a January 25 100 call, but the theta is mostly the last 3 months. It really gets nasty, and then the worst thing is just buying a call option. Every option, call or put is overvalued. You know, Ken Griffin is going to be the richest man. He owns the biggest casino in the world, and he sells overvalued shit, and people just can't resist buying it. So, you know, if I'm buying a call, I do like to try and sell, try and get, you know, just try and have less, you know, calories on the trade, less bad extrinsic. And so I have been willing to forfeit the short term. And yeah, I'm confident in 18 months, not 3 months, or I'm confident in 12 months, not 3 months.
Okay.
And so I've got a rolling, I sell 30-day forward and I sell 60-day forward, like 103s. So I'm selling the calls. Cheapens. I don't sell a lot, but you know, heavens, we've been trading like that since about March or April, and I think we're off about 10% from where we started. I mean, I'm really happy with that. Really, you know, remember I've got 5 or 6% of my NAV in this position, and so I've lost 50 basis points, and yet I'm loaded. You know, so that's my thing. And the instrument, forgive me, but you know, I'm addressing a Twitter type market, and so it's the TLT is the ETF, and the ETF has great liquidity, and it goes out to Jan 25. So.
Hugh, when you assess the recession risk now, and when you look at the price action that you just described with the risk scenario unfolding over a 12 to 18 month horizon, while you feel a little bit more comfortable with the very near term future, how reminiscent is this of, say, summer 2007, ahead of the great financial crisis? Do you find similarities in the way that we look at the world right now?
Yeah. I'm trying to pour water out of a very large bottle and not succeed. Just getting wet. I tell you what comes instantly into my mind with that question. I'm unnerved. I don't like this week. Is certainly not a victory lap, but you know we got that CPI print 3%. We got the PPI 0.1 as expected, and you know over the course of the next 3 months, the shelter number is going to come out. Things going down, but what is unnerving has been that huge move in the dollar low, and allied to that, the commodity complex, the industrial commodity complex, is catching a bid. Modest, but I look at these things a lot, maybe too much, and. So is that a 2008? You know, is that, you know, because again, the dollar, so what happens? The market, if we were to rationalize the behavior of the madhouse, the market always bets that the Fed's got it right, that it's a soft landing, and so stocks, you know, they go to all-time highs just as the Fed pivots, and the dollar goes to lows on the basis of interest rate differentials that the Fed will turn dovish and cut rates. And so the 2008 handbook would be the industrial commodity complex catches a bid and the dollar gets sold down. Is that now unfolding? I didn't think we would see that. I'm undecided, but I'm closing this week with more uncertainty in my mind in terms of the probability of that. I'll come back to you. I don't have an answer to that.
Hello, this is an advanced AI voice robot. To those of you in the cheap seats, this concludes today's special program. To listen to the rest of the conversation, please join the tribe at patreon.com/Hendry. Goodbye.